Welcome to the deep dive. Today, we're really getting into something a lot of people encounter, especially now, with gig work and side hustles. That high-paying job offer, maybe paid in cash, maybe an e-transfer straight into your account, what everyone calls working under the table. And look, on the surface, it feels great, right? Quick money, feels flexible. Maybe you think, I'm dodging the tax paperwork. But the sources we've looked at, from like tax law experts to credit reporting agencies, they paint a really different picture. It seems like this quick win sets you up for two huge problems down the road. First, the immediate legal and tax headaches if you get caught. And second, this kind of slow financial disappearing act where you become credit invisible.
Yeah, that's absolutely the core tension here. You're essentially trading, you get that untaxed cash now, which feels good, but you might be giving up long-term financial stability, real security. If you're taking income this way, you really, really need to understand what safety nets and future opportunities you're potentially walking away from.
Okay, so let's tackle the first big one, the taxman problem, tax liability, even if it's cold hard cash or maybe an Interac e-transfer, something digital. The law says you, the person getting paid, have to report that income. Is that right?
That's spot on. It's your responsibility. And if you don't report it, well, the tax authorities, CRA in Canada, IRS in the US, they don't just forget about it. They can hit you with penalties and interest. And that interest keeps adding up, sometimes really fast. It's not just the tax you originally owed. It becomes much more.
But hang on, don't audits mostly go after, big companies? How likely is it for someone doing odd jobs for cash to actually, get flagged?
That's a common thought, but things are changing. Tax authorities are getting smarter, especially with tech. They do what's called a lifestyle audit. Basically, they look at the income you did report, and then they look at how you're living.
How does that work?
Well, if you're reporting, say, minimum wage income, but you're making big bank deposits, or you bought a new car, or you're paying rent on a pricey apartment, that doesn't add up.
Okay.
That mismatch is a huge red flag. The investigation might start not with the income you hid, but with the lifestyle you're, visibly funding somehow.
So the whole idea of cash being untraceable, that's kind of a myth now, especially with digital stuff.
It's pretty much dissolved, yeah. Any e-transfer, any deposit into a bank account, even using platforms like Venmo or PayPal,
Right.
it all creates a digital record. It's traceable.
And what about the person paying you?
Good point. If they're a business and they claim that payment to you as a business expense to lower their taxes, well, now there's a record on their side too. Eventually, the systems can cross-reference that. They see the business paid someone, they look at your file, see no reported income.
Yeah.
Bingo.
Okay. So say someone listening realizes, uh-oh, I haven't reported income for a few years. Maybe they thought the payer was handling it or they just didn't know. What can they do now? Is there a way to fix it?
Yes, but you need to act fast and proactively. Most places have something called a voluntary disclosure program, or VDP. It's basically a way to come clean about past unreported income. If you go to them before they come to you, you can often avoid the worst penalties, maybe even prosecution.
But there's a catch, right? A time limit.
A critical one. You absolutely must make the disclosure before the tax authority contacts you about it.
So if you get that letter in the mail saying they're auditing you or asking questions.
Too late. The VDP window closes. You lose that protection and could face the full consequences: back taxes, hefty interest, big penalties. Proactivity is key.
All right, let's shift gears a bit. This causes a ton of confusion. When you get paid under the table, does that automatically make you a self-employed contractor?
No, definitely not. That's a really common mistake people make. How you're a classified employee or independent contractor isn't just based on what the person paying you says you are. It comes down to the actual reality of the working relationship. The IRS in the U.S. uses what they call common law rules, and Canada has similar criteria focusing on control.
Common law rules. Sounds kind of formal. Can you break down how they figure that out? What are they looking for?
Sure. Think of it in three main areas. First, behavioral control. Does the person paying you dictate what work you do, and more importantly, how you do it? Do they set your hours, tell you the methods?
Okay, so micromanaging points towards employee.
Generally, yes.
Yeah.
Then there's financial control. Who's handling the business side of things? Do you use your own tools, or do they provide them? Do you get reimbursed for expenses? How are you paid regular salary or per job?
Right.
And finally, the type of relationship. Is this meant to be a long-term ongoing thing? Are there benefits involved, like vacation pay or insurance? Is your work a core part of their main business? If the payer controls most of these aspects, the government is likely to see you as an employee even if you are paid cash. And they, the payer, could be in trouble for misclassifying you.
Okay. But let's say someone is legitimately self-employed, a proper subcontractor. We know they have to report the income. What hits them when they actually file their taxes? Is there a surprise waiting?
Oh, there's often a big surprise, yeah. It's the payroll taxes. See, when you're an employee, your employer pays about half of your Social Security or Canada pension plan contributions.
Right. They match it.
Exactly. But when you're self-employed, you have to pay both halves, the employee portion and the employer portion. Your contribution effectively doubles.
Ouch. Okay.
And there's more.
Yeah.
You typically don't pay into employment insurance, EI, automatically, so you might not be covered if you lose work. Though sometimes there are optional programs you can pay into. Plus, you're responsible for setting aside your own money for income tax throughout the year. That takes discipline.
So, practically speaking, how much should someone in that boat really be putting away?
A common rule of thumb, just to be safe, is put aside maybe 30% of everything you earn, right off the top, for taxes. And when you add it all up, the doubled payroll taxes, income tax, maybe some business expenses you have, perhaps private insurance if you needed that amazing high hourly rate you thought you were getting, sometimes it shrinks down to maybe only 35 or 40% actually staying in your pocket as take-home pay. The real net amount can be much lower than it first appears.
Okay, so we've covered the tax man and the classification confusion, but there are other costs, right? Things that aren't about taxes but can really bite you long term. The personal safety net stuff.
This is where it can get really harsh, honestly. Often people don't think about this until it's too late. Let's talk about workplace injuries. If you're working under the table and you get hurt on the job, you likely have zero access to automatic workers' compensation coverage, WCB they call it in Canada.
And that covers medical bills and lost wages if you get hurt at work normally.
Exactly. But without that official employment link, you're on your own.
I remember reading an anecdote. Someone got seriously injured because safety wasn't followed.
Yes, we see these tragic stories. Someone falls off a ladder, breaks bones, or like one case, needed major dental reconstruction after an accident. Because there was no WCB claim possible. They were stuck paying thousands, sometimes tens of thousands, out of their own pocket for medical care, physio, and they had no income while they couldn't work.
Wow. So one accident could wipe out any money you thought you saved by not paying taxes?
Easily. It's a huge gamble. You're trading physical safety for maybe a slightly higher hourly rate. It's critical people understand that trade-off.
And what about way down the road, retirement?
Another massive hidden cost. If you're not reporting income, you're not contributing to things like Social Security or the Canada Pension Plan. These systems are funded by contributions based on reported earnings. So no reported earnings means no contributions credited to you.
What does that mean in real terms when you hit retirement age?
It can be absolutely brutal. We found one story, a grandparent who'd cleaned houses for cash their whole working life, never reported it, their government pension payout. Something like $10 a month.
$10 a month? Seriously?
$10. That's not retirement. That's demis.
Well, to poverty, frankly. The price of being financially invisible for decades catches up with you in the worst way.
Okay, that's really stark. And this lack of official income proof, it messes things up before retirement too, right? Like trying to just live your life.
Absolutely. Think about everyday milestones. Need to rent an apartment, landlords want proof of stable income, pay stubs, maybe a T4 slip or a W-2 form, just showing bank statements with random large cash deposits, that can actually be a red flag for landlords. It doesn't look stable, and they might worry about where the money comes from.
Yeah, harder to find housing. What else? Getting a car loan can be tougher without proof of steady employment. And the big one, buying a house. Forget about it. Mortgages require solid proof of stable reported income, usually for at least 2 years. No official income trail means basically no chance of qualifying for a mortgage.
That difficulty getting a loan or even renting, it really points to this bigger issue you mentioned earlier, financial invisibility. You might have money, maybe cash saved up, but in the eyes of the mainstream financial world, banks, lenders, you basically don't exist.
Exactly. And being invisible or underscored, meaning you have little or maybe bad credit history, it costs you. It's not just about big loans. Your car insurance rates might be higher. You might need a bigger deposit for a cell phone plan. If you do manage to get credit, the interest rates you pay are often way higher than for someone with a good visible credit score. It's like a penalty for being unseen.
And this isn't just a few people, right? The scale of this problem is pretty big.
It's massive. In the United States, Estimates suggest around 26 million adults have zero credit history. They are complete credit ghosts. And another 21 million are underscored, meaning their history is too thin or too problematic for a standard score.
Wow.
And unfortunately, this disproportionately impacts Black and Hispanic communities. They're about twice as likely to fall into that invisible or subprime category.
Okay, but here's something that confuses people. Why would someone be invisible if they're actually responsible? Like they pay their rent on time every month, they pay their utility bills. Shouldn't that count?
Logically, you'd think so. It absolutely shows
Okay.
financial responsibility. But the problem is, historically, those types of payments, rent, utilities, phone bills, even streaming services, haven't been reported to the main credit bureaus.
The big three: Experian, TransUnion, Equifax.
Right. We call those payments invisible credit. The companies get the money, but they generally don't share the positive payment data with the bureaus. So it doesn't help build your credit score.
And that missing score becomes this huge roadblock, especially for building wealth, like you said, through homeownership.
Precisely. Owning a home is still the primary way most households build long-term generational wealth in North America. If your credit invisible, you can't get a decent mortgage, you can't buy a home, and you're locked out of that wealth-building pathway. It's a systemic issue caused, in part, by missing data.
Okay, so people listening might be in this situation. Maybe their income is complicated. Maybe it is mostly cash or contract work. Maybe they're just starting out and don't have the usual pay stubs. What can they actually do? What are the ways to build that credit history?
Right, let's talk solutions. One really interesting tool, especially for someone starting from zero, is something called a credit builder loan.
Okay, a loan. But wait, if the problem is lack of traditional proof, how does taking out a loan help? And don't you need credit to get a loan?
But this one works differently. It's specifically designed to build credit. You don't actually get the money up front.
Huh. How does that work?
So the bank or credit union technically lends you a small amount, say $300 to $1,000. But that money goes into a locked savings account that you can't touch.
Okay. Still sounds weird. Why would I do that?
Because the real point isn't the money itself. It's the payments. You then make small, regular monthly payments on that loan for maybe 6 months, maybe up to 2 years. The lender's job is to report those on-time payments to the credit bureaus each month. That's what builds your positive credit history. You're basically paying a small amount of interest purely to demonstrate you can handle repayment reliably.
I see. So it's like manufactured payment history. And then what happens?
Once you've paid off the loan amount according to the schedule, the savings account unlocks, and you get the original principal, that $300 or $1,000 back. The keys are: find a lender, often a credit union is good for this, that reports to all 3 bureaus. Choose a payment you can absolutely afford and never miss a payment. That history is gold.
Okay, that's clever. What about using those invisible payments we talked about, like rent? Is that becoming possible?
Yes, this is a really exciting development. Using what's called alternative data, especially rent payments, is becoming a real game changer. The number of rental payment histories or trade lines being reported to credit bureaus has exploded, like increased over 30 times in just the last 5 years.
30 times. Wow. Does it actually help scores?
Significantly. Studies are showing that when positive rental history gets added to a credit file, it has a real impact, especially for people with no score or low scores. One study found that nearly a third, 31% of people who started with a subprime score moved up into near prime or better after just 5 months of having their rent reported consistently.
That's fast.
It shows the power of making that invisible history visible. Lenders are noticing too.
How so?
Well, major players like FHA Mortgages and Freddie Mac, they're now either required or strongly encouraged to consider positive rental payment history when they underwrite a mortgage. Their computer models are actually looking for it now.
So paying your rent on time could literally help you qualify for a mortgage now.
It's becoming a direct factor. It's seen as proof you can handle large, regular payments, which is exactly what a mortgage is.
Okay, besides the credit builder loan and rent reporting, any other quick tools people can use?
Yeah, a few other common ones. A secured credit card is a good starting point. You put down a deposit, say $200, and that usually becomes your credit limit. It's low risk for the lender, but your responsible use gets reported. You could also become an authorized user on someone else's credit card, someone with a good history, like a parent or spouse. Their good standing can sometimes rub off on your file, though be careful, their mistakes can hurt you too.
Makes sense.
And there are tools now, like Experian Boost is one example. They can link to your bank account with your permission, of course, and look for recurring payments like utilities, streaming services, even sometimes rent. and add that positive history to your Experian credit file. But fundamentally, especially if you're dealing with contractor or cash income, the absolute baseline is run your finances like a serious business. Track everything. All income, keep records, issue invoices if you can, track all your business-related expenses meticulously, keep those records for years, and honestly, get professional help. Talk to an accountant. They can help you stay compliant with tax rules and make sure you're claiming all the legitimate business deductions you're entitled to, which can help offset some of those extra costs. Hashtag out, Trafa.
So it really comes down to a choice, doesn't it? There's the appeal of that quick, untaxed cash right now, that short-term gain, versus the absolute necessity, it seems, of building that long-term financial foundation through, well, playing by the rules, documenting your income, and making sure the financial system can actually see you. Visibility is key.
That's the core lesson, absolutely. Whether you're paid by check, direct deposit, e-transfer, or cash, reporting your income properly, and then building a history of handling payments responsibly. Those are the twin pillars. They unlock everything else. Mortgages, fair loan rates, stability, ignoring them, trying to stay under the radar. You might feel clever for a bit, but you risk locking yourself out of major financial milestones later on.
Okay, so here's a final thought to leave everyone with, kind of building on that rent reporting success story. We've seen how making consistent rent payments visible can literally open the door to homeownership for people who were previously shut out. What other regular, currently invisible payments could potentially be tracked and reported in the future? Think about things like maybe consistent childcare payments or regular insurance premiums, maybe even subscriptions people reliably pay every month. Could finding ways to aggregate and report those kinds of payment histories be the next step in helping even more credit invisibles build that track record and achieve real financial security? Something to think about.